So, I've had so many people ask me about how do you actually get financing for your real estate investment. So people want to invest in real estate, but they just don't know how to get the money. So today I'm going to do a workshop on basically how do you find financing for your real estate investment. I'm actually going to post this on my website, and it's going to be on my website. It's going to have all the links to all the previous videos so that people can look back at it and basically ask any questions that they have. But this is mainly for real estate investors. So we're going to look at the different funding sources for real estate investors. All right. So, main things we're going to cover today is when you're getting owner occupied loans versus non-owner occupied loans. Okay. So, when you're getting a loan to buy a property, you can get a loan if you're going to live in the property, or you can get an investment loan if you don't plan on living in the property. We're going to talk about a little bit about the down payment assistance options. We'll discuss the difference between an FHA and a conventional loan, the pros and cons of those first time home buyer programs. We're going to even talk about some renovation loan options like the FHA 203K. We'll talk about the difference between a residential loan and a commercial loan, and then talk a little bit about hard money and private money. So if you're an experienced investor or know an experienced investor, they'll talk a little bit about hard money versus private money. So about me, I'm Professor Tiana. I'm with Hillman TikTok University, or I guess it's called HillmanTok University. And my goal is to make sure you all have all the tools necessary in order to start investing in real estate and build generational wealth. So I've been investing in real estate for 10 plus years now, and I've done everything from room rentals, student rentals. I've done Airbnb, travel nurses, Section 8 rentals, market tenants. I've done the BRRRR strategy. I've done house hacking. I've literally done everything. And therefore, I feel like I have tons of knowledge to help people. I'm also a realtor in the DC and Maryland area. So I actually help my clients buy their real estate investment properties. And then I'm also a property manager as well, because as you know, when you start buying properties, you're going to have to manage that property unless you plan to hire out. But I prefer to manage my properties. So here's some common rental property strategies. So one of the options is to live in a property, then you rent it out. So you're buying a property, you live in it for 1 year, 1 or more years, you're going to move out of that property and then rent it out. That is the easiest way to get started with investing, because most people can only really think about how they can afford their first property. So go ahead, get your first property, but get it with the ideal that you're going to actually move out of that property and rent it out eventually. So this is why I say, like, you don't ever really buy your dream home as your first home. If you want to go ahead and build this real estate empire, you're going to have to basically grow your way there. Another option is to do a live and flip. With the live and flip, you're still doing the same thing. You're buying that property, you're living in it for at least 1 year. And during that year is when you're actually doing the renovations. So that's different than a traditional flip where you don't actually live in that property, but you basically just have someone do the renovation. They can gut the whole property and you're not there. With the live and flip, you're basically living there. You're painting yourself. You can even like start your own like little channel where that you're showing yourself as you're slowly renovating your property. I like this option because if you've lived in the property for at least 1 year, then you avoid long-term capital gains tax. So long-term capital gains tax means that you'll get taxed at a higher rate when you go to sell that property if you've been living in that property, or if you have not lived in that property for at least 1 year. So traditional flippers end up paying a lot of money because they flip a property, they have to pay short-term capital gains taxes. That's at their typical regular rate. But if you're going to live in that property for at least 1 year, then you can pay the long-term capital gains tax, which is a lower rate. You can slowly update it, and then you get to benefit from what's called the 2 out of 5 year rule. So one of my favorite strategies, you buy this property, you're living in it, you're fixing it up. It takes you 2 years to do it. There is a IRS rule that says that if you've lived in the property for at least 2 of the previous 5 years, then when you go to sell that property, you do not have to pay capital gains taxes on it. So you basically can pocket all of that equity without paying taxes on it. So I love that option, and I think everyone should be doing that option because that way you can collect all that money without having to pay taxes on it. Another rental property investment strategy is to go with a small multi-unit. When we think about multi-unit, a small one, think about anything that's less than 5 units. So 5 units or more is commercial. That's a whole different type of financing. Small multi-unit is residential. So that's a duplex, which is 2 units. That's a triplex, which is 3 units, or a quadruplex, which is 4 units. The idea with that is to house hack. So essentially, what you would do is you would live in one unit and rent out the other units, right? So you buy a 4 unit property, live in one unit, rent out the others. After 1 year, you move out, rent out that fourth unit, and you buy another 4 unit property. Live in one unit, rent out the others. After that, you move out, you rent out that unit you were living in, you buy another 4 unit property. Next thing you know, you have the option in 3 years to own 12 units. This is what a lot of people like to do because they want to get those small multifamilies. Not all of the areas have those small multifamilies like that's readily available, and sometimes those properties just need a lot more work than a traditional home. Okay? House hacking is basically when you're renting out a part of your house. So you live in one part of your house and you rent out a part of your house. You don't have to do that in a multi-unit, right? You can house hack in your current home. If you have a 3 bedroom home and you want to live in one bedroom and rent out the other rooms, you can totally do that. You can rent it out to college students. You can rent it out to working professionals. You can rent it out to travel nurses. You can rent it out to whoever you want. You would put them through the same background check, credit check process as anyone else you would be renting to. But that's a way to house hack. It's one of the best ways to prevent you from foreclosing on your house if you say you lose your job because you have additional income coming in. Some people choose to live upstairs and they'll only rent out their basement because they want to live in the house. Other people are saying, like, no, I don't mind living in the basement. I'll rent out all the rooms upstairs and I'll just have the basement all to myself. You can do it however you want to do it. And then short-term investing, that's a really popular strategy right now. Short-term investing is when you're using platforms like Airbnb or Peerspace or even VRBO, and you're renting your property out at a nightly rate, right? So instead of someone paying for a month, they're paying by the night. Now, different jurisdictions are going to have different restrictions on whether or not you can do that. So please, please, please keep that in mind. Like, just even in my area, I'm in this DC, Maryland area. DC rules are different than Maryland rules. The way they define short-term rentals differs. Okay. So in one area, you can't, a short-term rental is anything less than 90 days. In another area, a short-term rental is anything less than 30 days, and there's extra restrictions. Some of the restrictions that they've recently imposed is that you have to live in that property. It has to be an owner-occupied property, right? In the past, that has not been the case. And in other parts of America, that is still not the case, where you have to actually live in a property in order to use it as a short-term rental. All right. So pay attention to those local laws that are varying by jurisdiction. So these are just our common strategies. But first, how do I even buy a rental property? People keep saying, like, take me back to the beginning. How do I even buy a rental property? And ideally, what you would do, unless you just have all the money in the world, ideally, what you would do is you would get a mortgage on the property. And basically, you're only paying the down payment. The bank pays the rest of the purchase cost of the property. And as a result, you pay the bank a monthly payment every single month towards paying off what the bank paid. Right. So that's going to look different. If I'm going to live in the property, then I can do a lower down payment. I can do something like 3% of the property price. So if it's $100,000, I'm gonna say condo because I can't buy a house in my area for 100,000. If it's $100,000 condo, 3% down on that is $3,000. Right. And if I don't plan on living in the property, they're typically going to require a higher down payment because it's more risk. You're not even living there. So on average, it's around 20%. So for that same condo, if you're not going to live in it and you're going to use an investment loan, you would have to pay 20% down. So that's $20,000 on a $100,000 property, right? So this is why I advise people to go ahead and live in the unit for at least 1 year so you can take advantage of that 3% down. It just makes real estate investing more and more affordable. You only have to live there at least 1 year. 1 year and a day you can move out without facing any issues because you did live in that property, so you can move out if that's what you want to do. All right. Even while you're living there, you can still rent out another portion of your home. So my 1 year could be that I live in one bedroom and I rent out the others, or that I live in the basement and rent out upstairs. I'm still living in the home. I'm still receiving my mail there. So keep that in mind. When it's an investment property and you're getting an investment loan, you cannot live in that property. You cannot, your lenders will not want you to live in that property because the way that the lenders do the math to understand if it's a good investment is by determining what the market rent is for that property. And based on that market rent, they tell you whether or not you can afford to purchase this house. Whether it's a house or apartment. All right. So they're looking strictly at it from a business standpoint. And so they don't want you living in that property and messing up those numbers. So when it comes to residential or commercial, most of us will be doing residential loans. It's so much easier to get residential loans. It's cheaper to get residential loans. The interest rates are better for residential loans. So typically buyers get use residential loans. That's for like a single family house. But you can also use a residential loan for a 2 unit house or a 3 unit property or a 4 unit property. But like I said, once we get to 5 or more units, you cannot use a residential loan. That means you're going to be using a commercial loan product, and those down payments can start at 25% to 30%. All right. So those are different requirements that the lender has to do. It's a process that they call underwriting. And during that process, they're basically reviewing all the documents in order to figure out if this is a smart business decision. All right. So for a lot of my investors, they're going to be using residential loans, the same old loans that everyone uses in order to get into their first rental property, right? They're going to live in there first and they're going to use that to get in. Also, you can use a residential loan for a rental property, even if you're not going to live in it. You just have to pay that higher down payment, right? So to qualify for a loan, there's a couple of things that you need. Number one, your lender's going to run your credit. So make sure you guys have a strong credit. That should be your first step. If you're like, I don't even know where to begin, what is your credit score is the main thing. I like to see 620 or higher, but you can buy properties with credit score as low as 580, but your interest rate is going to be higher, right? So we want to get as low an interest rate as possible in order to prevent us from having to pay extra money. So to qualify for that mortgage, they're going to see your credit score. They're going to ask you for your savings account because they want to know that you have enough to cover a couple of months, maybe 3 to 6 months of expenses. Say the day you close on the house, which means the day that you purchase that house, you lose your job, you can still at least cover 3 to 6 months of expenses while you get back on your feet. So they're going to want to see that savings in there. And that's the savings that you don't touch. In addition to that, they're also going to, that's what we call like reserves, right? Sometimes they use your retirement account as your reserves, as long as your retirement account has a statement that says, hey, I'm allowed to pull out this money early, you know? But they're looking at that. They're also looking at your savings to see how much, or your checking account. Like you can send them all your account information in order to help you qualify, all your checking accounts, all your savings accounts. So they're also going to look at that in order to see if you have enough saved up for your down payment and for your closing costs. All right. So like I said, your down payment that can range from 3% to 20% on average. And then your closing costs, that's going to range as well. Typically, I say 6% of the purchase price, but you can negotiate having the seller pay a portion of your closing costs. That's just an investment strategy that we use, and that your realtor can advise you on. So your credit report, they're gonna look at your savings, your checking account to see how much money you have saved. And they're gonna say if you don't have enough saved for your down payment, there are some down payment assistance programs, right? That's great. There are down payment assistance programs that will help you cover that amount. So a lot of people use that if they're limited on funds. And then there are closing cost assistance programs as well. All right. Now, sometimes those programs are grants, meaning it's free money. Sometimes those programs are loans, meaning you have to pay it back. Sometimes they're forgivable loans, meaning you have to pay it back, but if you stay in that property for at least 5 years, then we'll forgive it. Or if you stay in that property for at least 30 years, then we'll forgive it. So keep that in mind. In order to qualify for a mortgage loan for the house, you're also going to need to show your last 60 days of pay stubs and last 60 days of bank statements, right? This is for W-2 employees. They want to know that you are currently working. Okay, so if you just started a brand new job and you haven't had a job for a while, you need to just wait until you can have at least 2 months of pay stubs and bank statements. Now, sometimes lenders will have grace on you if you just graduated from college in the same major that you're working in. They may use that 1 year of college they may use college as 1 year and then your 1 year working experience and say like, okay, we'll give them credit for that. All right. So sometimes they may have mercy on you. Um, like I said, they're looking at the bank statements. They don't want to see any large major purchases. So if you're about to buy a house, don't go buy a car right before. Don't The biggest mistake people make is they end up when they're under contract, they're like, oh, now I need furniture. Let me go take out a loan or a credit card so I can purchase this furniture, and that can kill your whole deal. So don't go make any major purchases at all. You want to not change your job at all because it makes it harder for the lender to approve you. So you really don't want to change your job. You just want to be look as stable as possible. If they're also going to ask for your last 2 years of tax returns, especially if you are not a W-2 employee. So for my contractors, they may ask for 2, maybe sometimes 3 years of tax returns because they don't have the monthly pay stubs or the biweekly pay stubs in order to see like how much income you're making on a regular basis. They're going to look for your retirement statements. That can only help you because it just shows that you have extra money stashed away. And a lot of companies they match. So if you're giving to your retirement, your company will match, and all that money will help you to qualify for a loan. And then if you own other property, they're going to want to see the leases on those other properties. So to show like, hey, this property's already rented out, so I don't have to cover it. Okay, great. Now if it's not rented out, they're gonna be like, okay, well, now you have to cover that property and this one. That means you qualify for less. And they're going to want to see the mortgage statements on those other properties to see how much those properties are worth, to see if you can even afford 2 of these mortgages. Can you afford monthly 2 of these mortgages? Yes or no? They'll make that determination. All right. So lenders have a number of different types of loan programs. We're talking about in general, but each lender is going to have a different selection of loan programs. And each of the programs are going to have different requirements. Now, in general, it kind of seems the same, but overall, they're going to be different. All right. So your most traditional loan programs are the FHA loan, the VA loan. The VA is really for the military vets. A conventional loan, which is really for people who have better credit scores. FHA, they're okay if you have a lower credit score. And then they have rehab loans as well. In order to actually, I'm going to go through what your credit score needs to be for each of those. But there's also alternative loan programs, right? So some lenders will have some, not all of them, will have what we call investor loan products. So for instance, the DSCR loan means debt service coverage ratio. So they're looking at how much debt you have and how much income you have coming in order to cover that debt. They have the investor, the no doc loans. No doc. If you heard of 2008 real estate crash, there was a lot of no doc loans going out. So those I see those few and far between. But then they also have the fix and flip loans where they will actually give you some money to pay for your renovation in addition to the money that they're giving you to purchase the property. All right. And then, as I mentioned, they have the down payment assistance programs. Some of them are grants and some of them are repayable loans. So let's take a look at the minimum credit score that you need for these different types of loans. So for a conventional loan, they want you to have a pretty good credit score. All right. So minimum 620 credit score. And that helps you to avoid having a higher interest payment. Right. So if you have a 620 credit score, then your down payment is going to be around 5%, right? 5% of the purchase price. Now, if you have a really good credit score, a 680 or higher, then that's when you can get a lower down payment around 3% of the purchase price. Okay, now say your credit score is still around 620, but you don't want to pay private mortgage insurance. Anytime you pay a down payment that's less than 20% of the purchase price, you have to pay mortgage insurance. This is just an additional insurance that they tack on in order to basically say, like, oh, they're not coming with the full 20%, so we're going to charge them this additional mortgage insurance. That's going to be for any loan that's below 20%. All right. So if you don't want to pay mortgage insurance, you want to have at least 20% down payment, which is 20% the cost of the purchase price. Now, I told you for a conventional, that was around a 620 credit score at the lowest. With FHA, your credit score ideally is a 580 or higher. So that's still lower. With a 580 or higher, you can get a 3.5% down payment. So 3.5% down payment, right? Now, if your credit score is even lower, sometimes they'll accept you. Sometimes they'll send you back to the drawing board and say, like, no, I need you to pay off some of these things. But sometimes they'll say, like, okay, you have a 500. Hey, I tell you what. Instead of putting 3.5% down, how about you put down 10% of this purchase price and then we'll let you move forward with this property. Right. So that's an option as well. Keep in mind that the lower your credit score, the higher your interest rate. So if you have a really good credit score, you should be rewarded with a more favorable interest rate. If you have a really kind of crappy credit score, you're going to have a higher interest rate because you're a greater risk. When it comes to the VA loans, the VA is for the veterans, and the USDA loans, that's for farmland, there's no minimum down payment requirement. All right, so no minimum down payment requirement, and there's also no credit score requirement. All right, so they just evaluate your profile and they evaluate the land, but they don't actually publish a minimum. All right. So let's just go over this. FHA, you're paying 3.5% down. VA, 0% down. USDA, 0% down. Conventional is anywhere from 3 to 5%. Or it can be higher if you want to get rid of PMI. There is a program called the NACA program where you also have no down payment. It's just a super strict program that you have to abide by. And it can take you about a year or two just to get approved. The FHA 203K is the rehab option and is very, very similar to the regular FHA loan, except for they have the rehab component. And then, of course, we have the down payment assistance program. Now, the great thing is that all of these loan products, for the most part, can be used for a duplex, triplex, or quad. I say for the most part because I have to check on the USDA loan, but as long as it's farmland or like in that rural area, not farmland, but in the rural area, I associate that with farmland, then you're good to go. But all of these can be used for small multi-unit. So if you want a 2 unit, a 3 unit, or 4 unit, you can use all these loans. These are the same loans that people use for their regular home purchases for a 1 unit property, a single family property. All right, so let's just do a little bit of math. If I had an FHA loan on a $200,000 property, that means my down payment is 3.5%. That would equal to $7,000. So 3.5% down on a $200,000 property is $7,000. Now, if I want a more expensive property, because I'm trying to borrow a little bit, say I want a $600,000 property, I'm using the FHA loan, my down payment, that same 3.5%, is now $21,000. All right, so this gives you an idea of how much you should be saving. All right, you can only use one FHA loan at a time. So the only time they'll make exceptions is if sometimes if you're military, and you have to move out the area, or really anyone who's moving completely out the area, then they may allow you to use another FHA loan. But you can really only have one FHA loan at a time. All right. And then because you're paying less than 20% down, that's when you get that mortgage insurance premium, which is that extra fee. Now with a conventional loan, say I have a really good credit score, a $200,000 property with a 3% down conventional loan means I need to bring $6,000 down for my down payment. Now, if my credit score isn't as great, but it's still pretty good, it's giving 620. All right. So maybe not the 680, but the 620. I can spend 5% down on a $200,000 loan. That's a $10,000 down payment. Now, of course, if I go up to the higher price property, a $600,000 property, then 3% down of a $600,000 property is $18,000. All right. 5% down of a $600,000 property is $30,000. So we see why people want the lower down payment because they want to have to spend less money out of pocket. But keep in mind that if you do a lower down payment, that means that your monthly payments are going to be higher. All right. Conventional loans, you can have more than one conventional loan at a time. So if you've already used up that one FHA loan, you can have more than one conventional loan at a time, and that's how you can build up. Each bank will have a restriction. Some may say five, some may say six. Most of them say 10. So that's how you can at least get your first 10 properties. So y'all have no excuses. You can get your first 10 real estate investment properties. All right. So keep in mind you can use these for 1 to 4 units, and basically just pay attention to what credit score you need and how much your down payment is going to be. Okay, so let's talk a little bit about the renovation loans. Say you need a property, you have a property and it needs some work. I love those properties because you get to build your own equity. There are some loan products that allow you to do the work on that property with that loan. Because who has all these thousands of dollars to, number one, I have to buy the property, number two, I have to renovate it. So the FHA loan has a 203K loan. So write this down, FHA 203K, and it allows you to both purchase a property and also cover the renovations for that property. So you do the same 3.5% down payment, but here's where you have to do some math because this is going to be 3.5% down payment of the total acquisition cost. So that's going to be the sales price and the renovation cost. So you're going to have to make sure you get that quote to understand how much your renovation is going to be. All right. Now you can always go ahead and refinance this out later if that's what you choose to do, but you can use this FHA 203K loan on a 1 unit property, a 2 unit property, a 3 unit property, and a 4 unit property. All right. For the home style renovation loan, that's basically like the conventional side of the loan. So you need a slightly higher credit score, but basically is really similar in that you can use that loan to both purchase and rehab the property. All right. So that's going to be a 5% down payment, and it can go up to 10% down payment, depends on your credit score. And also it's always 10% if it's for a second home. Now, second home is not like a rental investment property. A second home is like your beach house. Like you actually plan to live there. You're not using it as an investment product. If it's an investment property, then you still need to do your 20% down. Okay. All right, so let's see. Okay, so the great thing is that there are down payment assistance programs. A lot of times those programs don't necessarily work that well with rehab loans because down payment assistance programs, they really want to make sure you're stable when you're getting your property. And they're going to have extra requirements. Sometimes they require you to take a class before you even look for homes. Sometimes they require you to take a class while after you're under contract. And get a certificate. So there's basically down payment assistance programs all across the country. You just have to find the ones in your area. And how do you find the ones in your area? You ask a realtor. Ask a realtor or even ask different mortgage lenders because they should be aware of the down payment assistance and closing cost assistance programs in that area. So we talked about a couple of ways to purchase real estate. Number one is the traditional way, your FHA loan, your conventional loan, your USD loan, or your VA loan, which is the veterans loan, right? You can also go private money. Like say you know someone who got a little money, a family member or a friend, or maybe you already have a parent or uncle who has a lot of equity in their property and they can take out a home equity line of credit and lend you that money. You can use a private money lender in order to do it. And basically, you guys determine what the terms are. You determine the interest rate, you determine how much your monthly payments are, you guys determine that. A lot of private money lenders may already have their own requirements set, but that is an option. Now, most of the time, private money lenders have higher interest rates. That's just how it is. Most of the time, they have higher interest rates. So a lot of people use the private money to quickly buy the house. They'll say like, "Oh, he has $100,000 of line of credit. I'm going to take that money from him and I'm going to do a cash offer so I can get this house for super cheap, and I can beat out other offers. I'm going to do a cash offer, get this house, I'm going to fix it up, and then I'm going to refinance it and put a regular loan on it because those regular traditional loans have lower down payments. It's not have lower down payments, they do, but they have lower interest rates. And I really want to tap into that lower interest rate. All right. Or you could sell that property as well. That's an option. Hard money lenders, similar to how private money works, but basically they're established company or businesses that lend out money when traditional banks won't. So hard money lenders are perfect for rehab projects because if there's no roof on the house, your lender's not gonna they're not gonna lend to you. A traditional lender would not lend to you. If you don't have like floors and the place just looks run down, the traditional lender may say, absolutely not. No, we're not going to do it. But a hard money lender, they'll say like, okay, we see your vision. All right. Okay, so we're going to lend you money for the purchase price and we're going to lend you money for the renovation. So the hard money lender does that. They have the highest rates because they're trying to get their money. That's all they do is get their money. They typically have higher points that you have to pay. Point is a percentage of the purchase price. So if a 1 point on a $300,000 home is 1% of $300,000, right? So they tend to have higher points, and that's just a fee that you pay. Like you just pay this 1% fee. So because they have higher interest rates, you have to have an extra strategy of refinancing in order to get a traditional loan on that property so you can get your lower interest rate. Or selling that property so that you can be done with it. Okay. So you work that out with the hard money lender. They're going to have their terms. Typically, they say that they don't look at your personal credit, but they do. Most of them do. Until you have a lot of experience investing in real estate, most of them still look at your personal information. But some of them just don't. They may collect the information, but they're not making a rash decision based on it. They're making a decision based on whether the property makes sense. Like, okay, you want to buy this property for 200,000. You want to put $50,000 into it. Okay, yeah, we do see comps in the area that are selling for 300, so that makes sense. So yeah, we'll go ahead and lend you that money. All right. All right, so how do you get a lower interest rate overall? Number one, the higher your credit score, the lower your interest rate. Also, the higher your down payment, typically the lower your interest rate. You can shop around for interest rates. Like one lender may say, like, oh, I'm just going to throw out a number there. We're at a 6.75. The other lender may say, oh, you can get a 6.7 with me. So you can shop around interest rates. You can buy down your interest rate. So if you have extra money, you can pay the lender to have a lower interest rate. It's not going to be as low. It's not going to go from 6% down to 2%, but you can pay a lender to have a lower interest rate. Also, sometimes new construction properties have lower interest rates because they bought those loans back when interest rates were low, and they just haven't had a chance to sell a property yet. So ask them. Now, sometimes there's the same interest rate, but sometimes new construction properties have a lower interest rate in those communities. You can pay points. You can also lock in your rate. So if you think the rates are going to go up, then you can say like, okay, I'm going to pay extra fee to lock in my rate. And then also a 15-year loan has a lower interest rate than a 30-year loan. Now, keep this in mind that a 15-year loan is going to have higher payments because you're paying the same amount of money, but in 15 years, but your interest rate is going to be lower. So your overall cost on that property is going to be lower. A 30-year loan will have a slightly higher interest rate because you're taking longer to pay it, which means you're more risk. So I would say when it comes to interest rate, just do a cost benefit analysis in order to determine if the property still makes sense. If you can still make money on that property, then that's how you know it makes sense. So when I say make money on the property, right now, I'm talking about cash flow. We're not even talking about appreciation, the property increasing in value. We're not talking about the tax benefits. So being able to depreciate the property over 27 and a half years. We're not talking about being able to pay down a debt or like putting a tenant in there and the tenant's paying those bills to pay down that debt. We're not talking about that. We're just talking about cash flow, period. Cash flow is how much money you have coming in, right? Your income, right? Typically that's rent, minus all of your expenses. So your expenses are going to be your mortgage. Your mortgage is your principal payment and your interest payment, right? So yeah, you bought that house for $300,000, but you're paying interest on it. So at the end of it, you're going to spend way more than $300,000 on the cost of that house in 30 years. So your principal and your interest payment, your property taxes, right? Property taxes throw people for a loop because they're like, oh, once you buy a house, your payments stay the same forever. No, the reason why your rent increases is because your landlord's property taxes increases as well. So your property tax is going to increase as well. Even if you pay off your house completely, you're still going to have to pay property taxes. All right. So your property taxes and then your homeowner's insurance, you want to make sure it's insured just in case anything happens. If it's burglarized, if there's a fire, if there's any type of act of God, anything, you want to make sure that your property is insured. So that's your principal, interest, taxes, insurance, PITI, PITI. In addition to that, you have to consider all of your additional expenses. Like if you're the one paying utilities as the landlord, if you're paying the gas, the water, electricity, don't do that. If you can prevent it, don't do it. Because if I don't have to pay my water bill, my shower is going to be super long. And I think other people think like that too. If I don't have to pay my electricity bill, I'm gonna leave all the lights on. So don't do that. You typically want the tenants to pay their own utilities, but there are certain scenarios where you really can't stop that. For instance, if you're doing a room rental situation, like you live in one part of the property and they live in one, it's really hard to divide that each utility bill. So you may do a flat fee for the utilities. All right. So your income minus all of your expenses, that equals your gross cash flow. Okay. So on a $150,000 property, right? So this is a condo in this area, but there are some other areas in America where you can actually get a house. In this area, it would be a condo. Say I have a 5% down payment. 5% means what? It's a conventional loan. So I'm saying $7,500 for my down payment, right? I'm just going to say I have a 10% interest because I don't know what's going to happen with interest rates. I hope they go down, but I'm just going to say 10%. It's a nice round number. I put it on a 30-year mortgage because I want to have a lower payment. My monthly principal and interest will be about 1,251. My property taxes, that varies, right? In the same city or the same state, you can have different property taxes. In this area, they're more expensive. In this area, is not. All right. I'm saying $100 monthly insurance. I'm saying 85, and then because I didn't put down 20%, I'm saying I'm paying PMI, which is mortgage insurance, which is around $100, right? So altogether, I'm paying $1,539. Those are my expenses. If I'm able to rent that property out for $2,000 a month, that means 2,000 minus 1,539 equals $461 a month of gross cash flow. All right. So this is what I'm looking at, right? On average, real estate investors, we're looking at, depends on how many units you have, but I say on average, we're looking at least $300 per unit, right? So if I'm making $300 on this unit, and I get 10 units, I'm making $3,000 a month, right? In some parts of America, you can replace your salary, right? All right, I live in a more expensive area, so now I need 20 units in order to get $3,000. I mean, in order to get $6,000 a month because I'm making $300 per property. All right. So this is how people are actually able to replace their income in order to use real estate investing and their tenants' income in order to cover their expenses. Because if you're making that money, you can cover your expenses. That's called financial freedom. When your investments cover your expenses, that's called financial freedom. You're not working for anyone for it. Your investments are covering your expenses. Okay? So, like I said, at the end of the day, 10% interest rate seems crazy, 7% seems crazy, 6% seems crazy, 15%, 18% seems crazy. I know we want those 2%, 3% interest rates, but even if you don't have them, it really comes down to the numbers. Real estate investing is a math game. It really comes down to you having the real estate property analysis background and practicing doing your analysis to make sure that that property makes money for you. All right. So that's how we go ahead and invest in real estate. Let me go ahead and stop this recording then.